are tracking a developing story. Almost 30,000 people are now displaced in Alberta as the province has declared a state of emergency. It is battling wildfires. It's also affected production in the energy sector. For more, let's bring in our Western Bureau Chief, Tara Weber. Tara, give us a sense of the scale of these fires.
Well, as of late yesterday, there were more than 100 active fires in the province's northwest. About a third of those are classified as out of control. And so we are seeing evacuation orders that have been issued for a number of communities, including some that are less than 100 kilometers away from Edmonton. So, this is affecting and threatening some energy infrastructure as well. Conditions do remain volatile. Officials say the extent of damage at this point is difficult to determine because it's such a situation that's developing right now. So this isn't the first time the province has faced some energy issues with wildfires. I mean, just think back to 2016, and there we saw those wildfires that really affected the region around Fort McMurray. This time is different. Whereas Fort McMurray is where the heavy oil extraction is concentrated, this time it's more the Duvernay and Montney players that are really being hit. And this is where it's more natural gas production than oil. So we are seeing the shutdown of a number of oil and natural gas wells, pipeline systems. Fox Creek is a community that's under evacuation order. So this is a major center for light oil and gas drillers. And, energy facilities also being evacuated in Grand Prairie, another major city, along with some of the local residents there as well. So a number of names really being affected at this point, but there is some good news. The extreme heat has broken. I just looked, we're at 8 degrees in Calgary today. That's helping after a weekend that was very hot, and we've had a bit of rain this weekend and into today. So we'll get another update at 3 p.m. Mountain from the province.
All right, that is a bit of good news courtesy of Mother Nature. One of the other aspects of this is what companies are affected. We've seen a number of them issue press releases. Can you just sum up the number of companies and what they're saying about the affected projects?
Well, at this time, there are a number of them. The good news is there that they say they've shut in production, that no staff has been harmed, so we should start with that. But among the names here, we've got Vermilion, Scotia calling this a negative on the stock, that temporarily shutting in about 30,000 barrels of oil equivalent a day means about 35% of its total second quarter production. And Scotia saying, based on our early stage estimates, the second quarter cash flow per share has decreased by about 6%. Likewise, we've got Crescent Point. They've temporarily shut in about 45,000 barrels of oil equivalent a day. Scotia saying this is a precautionary measure and no damage has been reported to their assets, but shut in production there about 29% of second quarter production. And based on early stage estimates, they expect cash flow per share to decrease by about 4%. And, just keeping going here, Tourmaline, another major player, that one has shut down 9 South and West Deep Basin gas processing facilities as of Friday afternoon. It says it's not aware of any damage right now to its facilities and that all staff and families have been safely evacuated from the operative facilities and homes in the greater Edson area, but access to the sites is prohibited at this time. Also saying it's going to provide some updates on production resumption and the total production impact on second quarter in subsequent updates. We've got Tidewater Midstream and Infrastructure shutting down its Brazeau River complex. This is a big gas processing facility west of Edmonton, again evacuating all personnel. Cenovus shut down production and halted plants in some areas. And then when we think about all the pipeline infrastructure through this area as well, we've got TC Energy saying it's halted 2 compressor stations on its Nova gas system nearest to those active wildfires, and then other sections of the system and other networks will continue to operate safely at this time, but keeping workers away and just watching this at this time. And then Trans Mountain as well, we know construction's going on that huge pipeline expansion. This is the only link right now carrying Canadian crude to the Pacific coast. It is still in operation, but the company has deployed mitigation measures, it says. That includes a perimeter sprinkler system at the Edson pump station and will deploy additional protection if needed as well. But obviously just the impacts of these fires is quite widespread at this time.
All right, Tara Weber will continue to track these developments for us as she leads our coverage about these fires.
Suncor cash flow was slightly above consensus in the latest quarter, but its profits were still down by a third from a year ago. Higher expenses, lower refinery activity, and lower oil prices were part of that. There has been a big change at the top of this company. The new CEO, Rich Kruger, just took over the helm at Suncor at the beginning of March. He sat down with our own Tara Weber. Now, the company has been through a whole bunch of transactions, buying Teck out of an oil sands project, agreeing to buy Total Energies, oil sands assets in Canada, selling off renewable assets, getting out of, or completing a deal to get out of the North Sea. So Tara started off by asking Kruger if the company is taking a pause from all this deal making we've seen so far.
I think in particular the recent transaction with Total Energies, that addresses a fundamental strategic issue we've had about long-term bitumen supply to our base plant upgraders. With that now, anything here forward, whether it's internal development or it's a M&A, it's all about value. It's what we decide we can create the greatest shareholder value on. So I don't think there's a bias or an urgency for anything. The timing, scale, scope will be what fits the best.
And with the Surmont part of the deal, if ConocoPhillips does, utilize its right of refusal, what's the plan B there?
Well, I think it's speculative, right? It depends on how that comes about. We'll see. They've got some time. I understand their rights. I've confirmed to ConocoPhillips personally that they would be getting with us a partner who would want to invest and grow, maximize the value of that asset, a partner that we think we could bring things because of our experience at Firebag and elsewhere that could help improve that asset. So I'd prefer to think right now that we're going to be partners, and if we're not, we'll figure out what's next.
Okay, well, bigger picture, you're coming over to take over the helm at Suncor as it has faced a number of safety and operational issues. You've had 5-6 weeks to look around. Is there anything in particular you'd like to change right away?
Well, I've spent a fair bit of time initially going to the operating sites, meeting people, looking at facilities, spending time with the leadership team, getting a sense of priorities. And what I find is our management systems, safety management, integrity management systems, I think they're sound. Where we have room to improve is in the application and effectiveness of those systems. So this is an area that's always been a priority for me as a leader. I think I have fundamentally a moral obligation to provide a safe workplace, and I think this organization shares that value. So we'll be looking at how we can continue to strengthen our leadership to get that result, a workplace where people don't get hurt.
Well, one of the other areas you were talking about is targeting efficiencies. What does that look like? Does that mean layoffs?
Yeah, for me, that everyone above the operating asset level, whether that's above a refinery, whether that's above a mine or a plant, we all exist to support where the money is made, and the money's made at the facilities. So I like that everyone would have a line of sight from what they do to how they support the asset. And what that means ultimately is, yes, I'd like to be more cost effective, but really I'd like to focus people's efforts to ensure that whatever work they do complete is the most valuable work. So we'll have a lot of line of sight kind of assessments and focus to get the biggest bang for the buck. We make money in Fort McMurray, we make money in our refineries, we make money selling at Petro-Canada stations. People here and above in the center, we help people make money. We just need to be sure we're helping as absolutely best we can.
Speaking of those Petro-Canada stations, we just saw that big deal when it comes to Canadian Tire. What's interesting is this is a segment where there's a lot of security and a lot of closed mouths, but you have insight into Esso and Imperial. So how did that insight change this deal?
Well, I think, if I think of the deal, I love the deal. It's an awesome deal because what it does, it benefits from our brand, obviously. It's a deal that both parties win. This is a win-win for Canadian Tire and Petro-Canada or Suncor. So we get our brand, we have offtake agreements from our refineries for longer term, so we know we can run and operate our refineries at their capacity, supporting our own commitments on it. And I think what that does is it strengthens not only the Petro-Canada brand, but it strengthens and allows us to perform and invest and sustain our refineries long term. So, I did some of that type of work in my prior life, and I went into my first Petro-Canada to buy gasoline a couple of weeks ago. Still, my hand was shaking a little bit when I went to the pump, but I figured I can get used to that in a hurry.
Okay. One of the things you said today is never forget the shareholders. You're speaking to investors. What does that look like for them over the next year?
Well, I know we're spending other people's money. The money we spend and invest is not our money; it's our shareholders' money. So I think getting to know our shareholders, understand what's important to them, and I think the value proposition we offer is a an investment that or a company that takes good care of its assets, provides a reliable and growing dividend. When we have surplus cash, we don't hold on to it, we return it to them. So to me, that's kind of our model, how I think we fit in. We selectively invest when we can grow the business and add value, but we don't outrun our headlights on spending and investment. We run a very efficient organization, and we keep rewarding our shareholders through our dividends, share buybacks, and hopefully share appreciation.
Okay, and my last question, you retired. You were done with Canadian oil sands. What made you come back?
It was an interesting one. I wasn't planned, wasn't pursued. But I got a call out of the blue one day. I was in gym shorts and a t-shirt, getting ready to go work out. I had a great conversation. Went and worked out. A couple days later, I got another call. I initially said, well, you don't want me, I'm retired. But then the more I thought about it, I think it's a great company, great people, great assets. And I actually think the experiences I've had throughout my career can be what this company needs to help it. It takes a team. We've got a big team here. But I think I can make a difference. And it's not about money. It's not about ego. I've had a very successful, satisfying career. I think I can make a difference for a lot of people, and that's what's in it for me.
Okay, let's dive a little deeper into the market story this morning. We mentioned that things got more optimistic after the inflation data that crossed at 8:30 Eastern Time. We'll show you a live look at what's happening in North American equity trading. The inflation data in the United States basically came in line with expectations, so investors are bidding up some stocks this morning. But did anything truly change? Let's get some perspective from Dennis Mitchell. He's CEO and Chief Investment Officer at Starlight Capital. Dennis, it's nice to see you. What do you think? Is there a new path ahead or a new thinking for the markets based on one inflation print this morning?
Probably not. I mean, it's the continuation of a trend that's been established since late 2022. So I don't think that this data point is really new, other than it just confirms that the trend is still our friend and still in existence. But I think the key sort of read from this is that you've got to pair not just the inflation readings, you've got to also look at the labor market. And so we're actually paying attention to initial jobless claims every week as sort of that proverbial canary in the coal mine, if you will, to get an idea of where we are sort of in that trend of inflation. If we continue to see very robust strength in the labor market, then that generally feeds through into stronger services inflation. You know, if people feel like they're employed and they're going to remain employed, their wages are continue to grow, they feel better about bigger ticket purchases, and this is a seasonally strong period for the housing market, but they also feel like they should be rewarding themselves after 2 or 3 years of lockdown because of COVID. So you can see it in attendances at movie theaters, amusement parks, and you can see it in sort of restaurant bookings and travel. So we're paying attention to the labor market and that initial jobless claims number to see if we have continued strength in the labor market. So
that's the kind of thing that I would imagine feeds into the idea of, well, maybe rates need to stay high or go higher. There was, I was saying earlier in the program that one of the Wall Street economists, Torsten Slok, shared this chart based on the Fed's loan survey this week, which highlights that because we've seen all this banking turmoil and you're seeing tighter lending standards right now, you already have that part on the banking side. And even if inflation trends improve, if they don't improve to the extent that warrants rate cuts, then that opens this door to whether or not a recession, a deeper recession, a longer than expected recession is something that is priced into the market. What's your view on that?
Well, I definitely don't think a recession is priced into the market. If you're trading at 18, 19, 20 times, that's hardly a recession multiple. So let's take that off the table. For later this year, what is concerning to me is that the market seems to continue to anticipate rate cuts later this year. Whereas where the Fed is positioned, they are opening the door to an additional rate hike in June and have not opened the door to rate cuts later this year. So that's a bit of a disconnect, and combined with the multiple the market is trading at, you know, I would say that your balance of risks right now are skewed to the downside in the market as a whole. But in speaking to recession, again, I bring it back to the labor market. It is tough to have a deep and meaningful recession if the labor market is very robust. So we're paying attention to that labor market as a sort of canary in the coal mine for a number of things. And then coming back to your initial point about the lending surveys, yes, they do indicate that credit conditions are tightening and continue to tighten, and that is negative for growth going forward and sort of feeds into that recession narrative.
I think I need an AI assistant to help me with all these moving pieces of the markets in 2023. Dennis, you're our real estate expert. A lot of our guests, our viewers, like to know your thoughts, and they've heard these headlines just given some of the where the economy's headed. They've heard about some of the uncertainty in the commercial real estate market. REIT's obviously a big area of interest in this country as well. Walk us through your assessment on that front, Canadian real estate right now.
Sure. And again, I would say it's dangerous to sort of lump all of the subsectors of real estate into sort of this commercial real estate label, if you will. There are certainly challenges in the office market. We've seen it in the REIT market where a couple of office REITs have had to slash their distributions by 50 and 70%. I would expect more from those office REITs, not just in Canada, but also in the US. And we've seen some challenges in retail REITs historically. Right? I mean, we had General Growth Properties declare bankruptcy during the financial crisis. During COVID, we had CBL and Washington Prime declare bankruptcy. So those are two areas where I would see risk. But I mean, I'm flipping it over to industrial, cell towers, data centers, residential. We're in the midst of earnings season, and those subsectors are demonstrating very, very strong same property NOI growth, very, very strong funds from operations growth, and we're seeing distribution growth. In fact, in our real estate fund, we've already had 12 distribution increases this year, and the average increase has been 15%. So again, it's dangerous to lump all of the subsectors into commercial real estate. You'll miss tremendous opportunities in other subsectors that are actually performing.
Well, and you made that point about people wanting to treat themselves or do some spending if you've got a job right now. And we had the founder of Ryokan, Ed Sunshine, on earlier this week, and he was saying, look, I mean, just in terms of the spending trends and people coming to our properties, from his vantage point, things still look relatively good.
Yeah, and I would agree. I mean, the Ryokan portfolio has gone through a huge transformation since when Eddie first founded the vehicle. They've got some residential in there now. They've skewed the portfolio more towards the core 6 markets in Canada, and have certainly skewed the portfolio more towards necessity retail. And Jonathan Gitlin is more than a worthy successor to Eddie, but we will certainly miss him if he does, in fact, full-time hang up his shovel, if you will, or his pencil, if you will. He's a great man, and you can't say enough about what he's done for the Canadian real estate industry. So I'm kind of sorry to see him go, but very happy to see Jonathan get his shot.
Dennis, it's great to see you. As always, appreciate your time.
Well, let's take a quick look at shares of one of Canada's largest commercial landlords, Ryokan REIT, following its first quarter results. We're seeing it's fairly flat trading day, a few ups and downs there, but at this point, just up 0.3%. The company reinforced confidence in its cash flow growth targets this year, supported by rising occupancy levels and rent rates ticking up. For more on the quarter, we are joined by Jonathan Gitlin, CEO of Ryokan REIT. Thanks so much for coming in. We appreciate it, as always.
Thanks for having me. I'm a little concerned if my Peloton's going to get recalled. I saw that last segment. I'm
if you bought it in the U.S., yes, but not if you bought it in Canada. We should have said that. Yes.
I'm safe.
Yes,
Great.
You're good. You're good. Okay, so there's been a lot of talk about the commercial real estate space and about lending in this space. A pullback in lending, also just concerns about, is this sort of the next shoe to drop when we're talking about economic uncertainty? What kind of conversations are you having right now around this?
Well, I'm trying to define the situation for a lot of people because there's a very broad brush that's being used to paint commercial real estate. Office is clearly going through some problems, and even more succinctly, office in the U.S. is going through some problems. But the difference between office and retail in Canada, particularly the kind that Ryokan has, which is unenclosed, necessity-based, grocery-anchored real estate, I mean, it's miles apart. It's the difference between a bicycle and a 18-wheeler truck. So I don't think there's a lot of relevance in terms of some of the concerns that apply to the broader commercial real estate industry for our business, which again is actually really seeing a lot of strengths right now.
And office makes up about 8%, I recall, of your portfolio, so not a huge proportion of it. When it comes to the lending environment, though, I don't know if you're trying to do any sort of financing right now, but are you coming up against anything there? Are there challenges on that front?
Challenges in terms of the cost of borrowing is more expensive than it has been in the past. I mean, we've come off 10 years of very, very cheap financing. In terms of availability, though, Jacqueline, we're not seeing a market that is tightened, not for Ryokan anyways. I mean, we've prided ourselves on being a very responsible borrower, and we have 5 great relationships with the 5 big banks in Canada, and we've got relationships with other lenders like Lifecos and insurance companies. And those types of lenders feel very comfortable, not only based on our track record, but also based on the solidity of the income that our product is producing. So we're not seeing a pullback in in borrowing opportunities. In fact, we see liquidity as not being a concern. That being said, we do have about $1.7 billion of liquidity on our balance sheet that we can access at any point should the lending markets dry up.
Right. What about the condo side of things and the financing for, the prospective buyers of condos that you want to be developing? Are you concerned at all about that side of things?
Well, as a Canadian, I'm always concerned about the health of our consumers and our homeowners. And I do think that we're facing a bit of an issue in terms of the number of homes available to the growing Canadian population. Insofar as Ryokan's concerned and its condominiums that it has in process now, the vast majority of them have been sold. So we have large deposits and we've got responsible buyers who have signed a contract to acquire the property. When they go to close, if interest rates keep on going up, there is always the possibility that they might not be able to procure the financing they need. I don't think that's going to happen because oftentimes these contracts were entered into years ago. So the purchase prices are below market. There's a lot of incentive for these buyers to want to close on our product. And so when it comes down to closing, if worst case scenario happens, and it would only happen with a small percentage of our overall portfolio, Ryokan also has a group called Ryokan Living that would be happy. I mean, we can take those units and rent them out. So it's not a significant concern for us. And I really think it's a pretty remote concern.
What about, how much do you have in the sort of planning stage where you haven't broken ground on it whatsoever, you're planning it? How are you navigating it right now? Because I thought it was an interesting conversation on the conference call, just talking about, well, you can do this, you can do that. So can you walk us through the planning part and how, I think you mentioned that you're just not feeling as aggressive about things in this moment when it comes to, pushing things forward from planning to breaking ground as quickly?
Yeah, so we're in a luxurious position in that we sort of get paid to wait, right? We have shopping centers. These shopping centers are highly productive. When we build, we're building typically in a discrete portion of that shopping center, or we're demolishing the shopping center and building above it. Either way, before we break ground, we're earning money. We're getting rents, right? So when it comes time to make the decision as to whether or not we break ground, if we say let's wait for a little while, it's not going to hurt us. If we say let's go ahead, the metrics have to be good. They have to be a way to make money for our unit holders that is better than other opportunities we have to allocate capital. So we're in a pretty good position. I think a lot of developers have taken their foot off the accelerator a little bit, just waiting to see what the market is like, what costs are like, because in Toronto in particular, over the last 5, 6, 7 years, the inflationary environment in construction costs has been very insane, for lack of a better term.
Yeah.
And so I think we're all just waiting to see where that settles now. But I don't think you're going to see a full cessation of building, Ryokan included in that. There's so much need for the type of property that we can build. I mean, housing, as you know, there's so much need for it, particularly in transit-oriented spots where we own. So I don't think it's not going to be a full lapse of development for Ryokan. But to answer your question originally, we've got about 16 million square feet of zone density that we can tap into when we need to.
And Jonathan, last time we talked about Bed Bath & Beyond, because you had 13 Bed Bath & Beyond locations that you were leasing to Bed Bath & Beyond, rather.
Yes.
You talked about not being concerned about needing to fill those spaces, and we've heard from several retailers already, or soon-to-be retailers. Rooms and Spaces was one of them. We interviewed the founder of that, who's planning to open several locations. you didn't seem concerned about their, demand for that type of space. Can you walk us through what's happened so far with those leases?
Sure. Once in a while, even I'm prescient in what I say, and truthfully, my lack of concern at the time was warranted. I said that because there is a lack of good retail space in Canada. No one's built any new retail space in the last decade. No one's going to build any new retail space because it's become so expensive due to those inflationary pressures I talked about before. So when our 13 well-established locations came up for auction, because that's what happened, the court procedure basically sold all of the assets that had value of Bed Bath. And so they went to auction with the leases because the leases have value. And tenants paid to get that space, to basically inherit Bed Bath's lease. So for Ryokan, 10 of our 13 were inherited or assumed by really good retailers. So now they just slide in. We have no downtime. We don't have to put out any costs. And then the 3 that are remaining, I can tell you, 1, we've already signed a lease deal with a really good user, and the other 2, stay tuned because they're in the midst of being completed right now. And again, I think that speaks to the value of good commercial real estate right now.
That's really interesting. I didn't know that it would happen in that sort of way. You didn't even have to lift a finger, I guess, for most of those. That's interesting stuff. Jonathan, great to speak with you. Thanks so much again for coming in. We appreciate it.
Likewise. Thanks, Jacqueline, for having me.
Let's take a look now at the U.S. markets. We're joined by Mike Regan. He's Senior Markets Editor at Bloomberg. Mike, thanks very much for coming on the show. Now, we are awaiting, here we have it now, the Michigan Consumer Sentiment Index. I believe it's down more than expected in the preliminary survey. Can you update us?
Yeah, that's right. The headline number was 57.7, a big drop from the prior month of 63.5, and the estimate for 63 in the Bloomberg consensus survey of economists. But really, I think what's catching a lot of people's attentions is the inflation expectation component of that report. The 5 to 10-year inflation expectations rose to 3.2%. That's actually a 12-year high, above what economists were expecting. 1-year inflation expectations also higher than expected at 4.5%. So, Andy, this is something the Fed has explicitly said they are looking at as part of their efforts to sort of sniff out where inflation is going in the future. So we did see a pretty strong reaction to it in the equity market, some selling, some climb in a 2-year yield as a response to this, too. So really a pretty relatively alarming report all around, both from the headline confidence number and those inflation expectation numbers, kind of, Andy, pointing a bit of a stagflation scenario from this report, at least.
My goodness. Worst of both worlds, the old misery index, consumer expectations down, but inflationary expectations stubbornly high. Because it's weird, isn't it? Inflation, the expectation as much as the actual number it's as important, isn't it?
It absolutely is. As it affects consumers' spending and their behavior, how they're thinking about the future. And like I said, it really is something the Fed has made clear that they're keeping an eye on. It's not just the reported in the books PCE and CPI numbers that they're looking at. It is the expectations in this Michigan report, as well as things like the break-even inflation rates in the bond market. So, not a good look for the Fed when it comes to what they're going to do in June.
What about Tesla? So it looks as though Musk is handing over leadership of Twitter to somebody else. Is that the reason why we've seen strength in Tesla today? People think he's going to be less distracted?
Two different things going on with Tesla today that are worth talking about. Yes, he is reportedly handing over the CEO role at Twitter to NBC Universal advertising executive Linda Yaccarino. Obviously, investors reacted to the initial reports and tweets from Musk himself yesterday that he had found a new CEO. Reacted positively to that yesterday. I think most people who invest in Tesla stock believe that this is a bit of a distraction for him to be also running Twitter at the same time. At the same time, Tesla also announced that it was increasing the prices, yet another tweak to the pricing of its Tesla vehicles, the S and the X models, the higher end models, prices there being raised by $1,000. Tesla was up pretty strongly in the morning on these headlines, this news. paired a lot of those gains, still higher for the day, but not as high as it was. I think really Tesla especially is reacting to that consumer confidence report more than perhaps even the entire market is.
And give us, finally, we're tight for time, sorry, give us the latest on Carl Icahn. He's been targeted by Hindenburg Research, the famed short seller. Carl Icahn, though, is hitting back.
Yeah, this is Icahn Enterprise is up about 6.5%, still down about a third since Hindenburg came out with its short report on the company. But the company has announced that it is authorized a $500 million share buyback plan. That's about 27% of the shares trading on the open market. This company has not done this type of buyback program really ever since 1987, according to its public records. So stock reacting pretty powerfully for that. But remember also the company announced yesterday an investigation from the federal government, the U.S. Southern District of New York, looking into a variety of things, including its due diligence, securities offerings, and dividends. So a pop in the stock today on that buyback news, Andy, but still down quite a bit with all the other news from Hindenburg and the Justice Department.
Mike, thank you very much indeed. Have a great weekend.